Regardless of what they do, the next thing they're going to do is cut rates. They're going back down to zero, but it's not going to stop the bear market, and it's not going to stop the recession.
Well, the first of those three predictions has happened. Yesterday, of course, as you know, the Federal Reserve cut interest rates by 1/4 point. Now, we said we would bring Peter back when he was right, and we are here in all his told-you-so glory. Is Euro-Pacific Capital CEO Peter Schiff, who was arguably the very first all the way back in December of 2018 to have predicted that the Fed would have to cut rates before raising them. We're also joined by Signature Bank Chair Scott Schiff, who says it was a mistake for the Fed to lower rates, but not for the same reason that President Trump would say it's a mistake. Peter, I will begin with you. You boldly went where very few others, if anybody, had gone, and you said back in December they're going to be forced to cut, none of this hiking. So what was your first reaction when you saw the 1/4 point cut announced?
Well, I was pretty much expecting it. And also, though, as expected, the Fed or Powell was not honest about why the Fed was cutting. He's trying to pretend it's because of concerns about the overseas economies. It's really the U.S. economy that is driving the Fed. That's why this is just the first step on the road back to zero. And, you know, it was a mistake when the Fed went to zero the last time. It's going to be an even bigger mistake when they do it next time. And they're also going to go back to quantitative easing. You know, they announced yesterday the end of quantitative tightening, but the next step is to go back to QE. And QE4 is going to be bigger than QE1, 2, and 3 combined.
Scott Schiff, you say the Fed made a mistake. Now, the president would agree with you. He wanted it to be 50 basis points, but you're saying there was a mistake made, but that wasn't it. What's the mistake?
We have some serious problems. We have problems with trade. We have problems with our manufacturing sector. We're trying to right now trade soybeans for 5G equipment from Huawei. We are behind in quantum computing. We're behind in telecommunications. Frankly, I think that doing financial engineering with 25 or 50 basis points is besides the point. It may be inflating and it may support our financial markets, but we have some very, very serious issues, and we're distracting ourselves from that, frankly.
What should the Fed have done, Scott?
I don't think it was necessary for the Fed to have cut. I think they should have stopped quantitative tightening because there's no reason to be sucking liquidity out of the marketplace. But in an environment with a 3.8% unemployment, where we now have 125,000 people who are out of the job market coming into the job market, that's pretty actually impressive. I think it's time we deal with our $1 trillion deficit and, again, all of the fundamental issues about our competitiveness. We really need to face those issues.
Well, yeah, well, don't hold your breath. But, Peter, we've got a situation going on with the markets right now. About 2 hours and 20 minutes ago, the president tweeted that he was going to put in effect a brand new round of tariffs on $300 billion more in Chinese goods coming into this country. We had been up 311 points for the Dow. We're down 236 right now. We also saw the 10-year yield, if we can put that up, because to see that kind of precipitous drop of 18 basis points, we went from, what, 2.06 down to 1.8. Well, it was as low as 8.7, I think. Now it's at 1.89. What are the ramifications, and where's the trade here?
Well, first of all, I think Trump was sending a message to Powell, not to China. This was basically Trump's insurance policy to make sure the Fed keeps cutting. But, you know, I don't think he needed the insurance. The Fed's going to cut. Look at the horrible manufacturing data that came out today, the weak construction data. The U.S. economy is going to recession, and it's headed there fast. And so the Fed is going to go down. But the trade, get out of the dollar, and look at gold. Gold's up about $30 today. We're just below $14.50. I mean, once we take that number out, we could really be off to the races. People are totally on the wrong side of this trade right now. People don't own gold and silver. They're too long the dollar. They have no idea just how much inflation the Federal Reserve is going to be unleashing, and it's not going to be good for stock prices. The inflation is going to be in the supermarket, not the stock market. All
right, we've got Bitcoin higher. Peter hates Bitcoin. Scott, you believe that this might be an alternative investment right now. We have it up $242 now at $10,266 per coin.
I agree, but I have to respond to that if you would let me. Again, I talk to a lot of purchasing folks who are clients, and what's worrying them is not 25 basis points. What's worrying them is, to some degree, what they heard last night. Maybe there's going to be a clean tech deal that's going to make all the CapEx that they might be purchasing obsolete, so why should I buy that now? Maybe the insurance industry is going away. Those are, again, fundamental issues.
But to Bitcoin's
To
point.
Bitcoin, I think Bitcoin is a store value like gold. So when times are sort of looking very uncertain, people flock to it just the same way they're flocking to other commodities to sort of hide from the marketplace.
Peter, you get the last word on Bitcoin quickly.
Well, I don't think it's anything like gold, and it's not a store of value. People are speculating in it. They're hoping that it goes up, and maybe it will go up for a while. But I think ultimately it comes crashing down. So I think the spec money maybe is chasing the bubble in cryptos, but the smart money is buying into gold and buying into silver because those are legitimate stores of value, and they are monetary assets, and they are going to shine when the dollar crashes.
Peter, Scott, we got to run because we've got a very fluid market right now. Thank you both so much. Peter Schiff, Scott Shea.